year to date is up 56%. Silver's up more than that, but gold's up 56%. That is the biggest one-year gain since the 1970s, and we still have 2.5 months left. But when gold started to move like this in the 1970s, it was the beginning of a huge move. Gold went from $35 an ounce when we began the decade to $850 when we ended it. So I think this is the beginning of a much bigger move in both gold and silver. I think what we're seeing now is a warning sign, similar to the warning that we got in 2006 when subprime blew up. That was warning about the financial crisis that hit the following year. I think what we may see next year is a U.S. dollar and sovereign debt crisis. The world is divesting of U.S. dollars. Central banks are unloading dollars in Treasuries, and they're buying gold. And I think this means the U.S.'s ride on the global gravy train is coming to.
Gold is up 56% so far this year, its biggest annual gain since the 1970s, with silver rising even more. Lease rates, cost of borrowing physical silver, spiked above 30 to 35% for short durations, signaling stress in the silver marketplace. However, gold recently broke records, trading above $4,100 amid rate cut expectations and geopolitical uncertainty. Analysts in several outlets warn that the rapid gold rally may be more than a speculative bubble, but a signal of deep systemic stress in the financial system. The current conditions resemble the early signs of the 2008 financial crisis, suggesting that the next major shock could be a U.S. dollar and sovereign debt crisis. As central banks worldwide sell off dollars and treasuries while buying gold, this signals the beginning of the end for America's long-standing financial dominance. Peter Schiff, an American economist, investment broker, author, and financial commentator, points out that silver has reached a new record high at $52.20, surpassing its 1980 peak, while gold is up this year. The run in gold and silver supports Schiff's view that these metals are entering a major bull phase. The record highs, extreme lease rates in silver, and strong institutional inflows all match his expectation of rising demand outpacing supply. Many recent forecasts now target gold in the $4,500 to $5,000 range or higher, lending credibility to his longer-term bullish stance. J.P. Morgan's forecast is significantly more conservative than Schiff's extreme scenarios, indicating skepticism in the broader market about how far and how fast gold can go. Meanwhile, silver's backwardation and squeeze dynamics provide real, market confirmation of physical stress, something Schiff often emphasizes over paper contracts. Analysts caution that silver's rally is fragile due to its industrial ties and lack of central bank demand, making it prone to pullbacks. Schiff warns that a U.S. dollar and debt crisis could emerge as central banks shift from dollars. The markets are always shifting. Don't fall behind. To keep ahead of the curve, subscribe and like this video. Please leave your comments in the space provided below. We would be very grateful to hear from you.
First of all, Liz, spot silver is at $52.20. It's actually, you're quoting December futures,
Correct.
which are normally above the spot market. They're actually below. I think we're setting ourselves up for a huge short covering rally. But this is an all-time record high for silver. It's eclipsed the peak from 1980. Now, not adjusted for inflation, but just the nominal price is now higher than at any point. And in fact, gold year to date is up 56%. Silver's up more than that, but gold's up 56%. That is the biggest one-year gain since the 1970s, and we still have 2.5 months left. But when gold started to move like this in the 1970s, it was the beginning of a huge move. Gold went from $35 an ounce when we began the decade to $850 when we ended it. So I think this is the beginning of a much bigger move in both gold and silver. And, first of all, what it tells you about the stock market, the U.S. stock market's really been in a bear market for 26 years, because in 1999, the Dow was worth 45 ounces of gold at its peak. It's now worth barely 11. So that's a 75% decline in the real value of U.S. stocks measured in real money. But I think what we're seeing now is a warning sign, similar to the warning that we got in 2006 when subprime blew up. That was warning about the financial crisis that hit the following year. I think what we may see next year is a U.S. dollar and sovereign debt crisis. The world is divesting of U.S. dollars. Central banks are unloading dollars in Treasuries, and they're buying gold. And I think this means the U.S.'s ride on the global gravy train is coming to an end, because we base our whole standard of living on the dollar's reserve status. We use that to consume more than we produce and to borrow more than we save. And when the world doesn't want our dollars anymore, we're not going to get their goods. They're not going to loan us money by buying our bonds and our mortgage-backed securities. So Americans are going to be looking at much, much higher consumer prices, much higher interest rates. And this sovereign debt and currency crisis will make the 2008 financial crisis look like a Sunday school picnic.
Peter Schiff here discusses that investors don't need to buy a full ounce of gold. They can invest smaller amounts through ETFs or by purchasing fractional pieces. Schiff believes gold and silver miners are extremely undervalued, with earnings growth far outpacing other sectors. Despite gold's major price gains, he says Wall Street has largely ignored the opportunity, though some major firms are finally beginning to recommend adding gold to investment portfolios. Let's get into the details of the interview for further insights.
Well, first of all, you don't have to buy a whole ounce of gold. You can invest whatever you want. You can buy gold ETFs. You can buy fractions of an ounce. And silver, people can buy silver $52 an ounce. You can buy plenty of ounces of silver. We sell silver and gold at Schiff Gold. But I really like the mining stocks. Pan American Silver is probably the highest quality of the silver miners. It's not up as much year to date as like a Coeur d'Alene or a Hecla. But if you look at a longer term chart, Pan American didn't go down nearly as much as those stocks did. So it didn't have that lost ground to make up. But it's a great quality name if you're just going to buy one and you want less downside risk. Agnico Eagle also hasn't done as well as some of the lower quality miners in the last few months. But zoom out, it's been a phenomenal stock. Okay. AEM right now is $171 a share. I've owned it for 20 years. I bought my first shares below $10 a piece. So it's been a huge winner in the gold space when a lot of other gold mining companies were having a lot of difficulty. But pretty much now you could just throw a dart. I don't see how you don't make money buying any gold stock or silver stock. I think the whole group is ridiculously cheap. And the earnings are exploding. There's no other sector of the market that has the earnings growth that gold and silver companies have. And Wall Street has completely missed the boat so far. They haven't been invested. In fact, a year and a half ago, they were putting sell signals out on the mining companies because when gold was at 2,000, they thought it was the top. They said that there's no upside in gold. Well, it's more than doubled since then, and Wall Street still hasn't really embraced these names. Now, I'm just starting to see, for the first time, I've been in the financial industry for 35 years. This is the first year that I've seen any firms, like Morgan Stanley came out and said maybe the 60-40 portfolio should be 60-20-20 with 20% gold.
Right.
So I think investors are just starting to buy.
Why does Peter Schiff believe gold and silver mining stocks remain undervalued despite their strong earnings growth and record-breaking metal prices? If you appreciate this video, please hit the bell button for timely updates, subscribe to the channel, and like the video. Also, leave a remark with your ideas. We value your presence and thank you for your support.